don't think we're doing the cha-cha, but it's really what's happening in the market, Danny. 2 steps forward, 1 step back. And what we're talking about is, all of the talk about where we were on Liberation Day. Well, we're up and above where we were on the tariff day, April 2nd, and here we go back up into the positive. And I know that's not getting a lot of attention. This week, however, there was a lot of attention on 2 major stories that we have to talk about, and let's talk about Moody's getting moody.
That's right. So Moody's a credit rating agency, and there are 3 main credit rating agencies in the United States. There's Standard & Poor's, there's Fitch, and there's Moody's. And Moody's decided that over all of these years, a number of administrations, the direction of the debt in the United States is not really sustainable. And so they finally decided that they were going to remove that AAA rating from the U.S. government debt. Now, my view is that a credit rating for the U.S. government doesn't really make a lot of sense, because a credit rating is supposed to measure the likelihood of them defaulting on the debt, not making good on those contractual obligations with those treasury bills, notes, and bonds. And the U.S. government prints its own currency, so it's going to make good on its debt. That's where I think the credit rating agencies are stepping maybe into a little bit about, hey, what's the investment merits of it? What direction are interest rates going? And that I think we can obviously argue about.
And that is really the story, because to me, the true arbiter is the market. The 10-year Treasury up over 4.5%. And that means a lot to investors, because higher interest rates reverberate through both the equities markets and the debt markets.
They do. And if you think about it in terms of if you're a borrower, right, if you're looking to buy a home, the fixed rate mortgages, those are tightly tied to what happens in the treasury market. And so we've seen those yields go up. If you're an investor, you might look at it in terms of, hey, is now a good time to lock in those rates that I can get on these treasury securities? So we do see a lot of people finding that when we get the 10-year treasury above 4.5%, it's almost like this kind of magical line where people are like, ooh, that's actually not that bad in terms of long-term income generation. But you do have to live through the volatility, the ups and the downs, because if those yields go up, the prices of the bonds can go down. So you have to ask yourself, can you hold them through that type of volatility? As you mentioned, it also affects the equity markets, right? Because corporations, they borrow money. Also, when we're looking at stocks, you have to look at it relative to other investments. How attractive are stocks relative to bonds? And so when those yields go up, sometimes stocks are just a little bit less attractive.
And a little bit less attractive. However, this quarter's earnings season is just wrapping up. In all, margins were up about 17.6% annualized. That's pretty good. What that argues, in my opinion, is that you can apply a larger multiple to those earnings, and that supports where we are on the S&P 500. Most of Wall Street has us going higher sometime throughout the year. So that is good news. And the last thing I really want to point out with earnings is there was some really good earnings reports. However, the sectors matter, right?
Oh, yeah.
Energy, healthcare, some of the utilities, for example, financials, those were doing better than the normal tech stocks. However, the triple Qs are back up. The other big story is the big, beautiful bill.
That's right. H.R. 1, I think, is what the House of Representatives labeled it, right? It's the first piece of legislation that they began working on, and that finally did make it out of the House. It wasn't really all that smooth sailing getting it through, but that's part of the legislative process. It's the give and the take. And so some of the major provisions, right? Extending the Tax Cuts and Jobs Act, the tax rates that we have now, trying to extend those into the future as well, into 2026 and beyond, but then making some important modifications as well. What's happening with SALT, the state and local tax deduction. One of the compromises that had to be made was right now it's $10,000, is maybe that can get bumped up to $40,000.
And that's what the House of Representatives put in, and it made SALT pretty salty, right? And so we'll see what the Senate, now the bill's to the Senate, we'll see what they come back with. It's worth a conversation, right? Because the people who really pushed for it were the high-tax states, New York, New Jersey, and California. And so if this House wanted to buy those votes, they had to say to those folks, we're going to push up this SALT tax to $40,000. but it does phase out for higher income earners, right? The downside is, and we've heard it from our clients, not in those states, but in places like Florida and Texas, that they feel that they might be subsidizing some of this. So it is, as you said, it is horse trading for sure. And so we want to pay attention to that, how this really moves through. There's a lot of detail in this tax bill that's going to get negotiated out between the two, right? We'll see what comes out and actually goes to the president's desk.
That's right. And I think that it's also important to look at the timeline here. The goal was to get it out of the House before Memorial Day weekend. And in fact, they did make good on that promise. And now their goal is to really look at July 4th as being when they can reconcile the differences between the Senate and the House. I'm confident that they'll do it. There's probably going to be all sorts of fireworks in the process.
Fireworks, and well played, right? Because
Yes.
that's probably when we'll see it, is July 5th.
Exactly. And then we also do have to worry about the debt ceiling. As part of this discussion, they are going to try to raise the debt ceiling. And according to Treasury Secretary Besant, they almost need to do that come August. It's really difficult to forecast, like, when is kind of that drop dead date where they run out of these ways, that kind of accounting maneuvers that they can do. And the time is not, the clock is ticking. I wouldn't say that time is of the essence quite yet, but the clock is ticking and it's getting louder.
And it really is. And there's a lot of detail yet that has to be hashed out. And there's a lot for us to hash out over the next couple of weeks. Folks, this is the time to make sure that you're doing tax planning, that you understand what's in your portfolio, why it is there, and it's tied together with your estate plan. That is wealth management altogether.